Hello everyone. Today we're going to talk about the standard deduction and itemized deductions. So the standard deduction is a specific dollar amount that reduces the amount of income on which a taxpayer is taxed. Using the standard deduction eliminates the need for a taxpayer to itemize his actual allowable deductions, such as medical expenses, charitable contributions, or state and local taxes. The standard deduction amounts are based on a taxpayer's filing status and are adjusted every year for inflation. The filing statuses are single or married filing separately, head of household, married filing jointly, or qualified surviving spouse, and there is a dependent standard deduction. For itemized deductions, it is necessary to understand that an itemized deduction may be taken in lieu of the standard deduction. They allow taxpayers to reduce their taxable income based on specific personal expenses. In most cases, taxpayers may choose whether to claim itemized deductions or the standard deduction, depending on which is more beneficial or which is a higher amount. There are certain situations where taxpayers are required to file the itemized deduction and cannot take the standard deduction. Those situations include married filing separately filers, where both spouses are filing MFS and one spouse itemizes. In that case, the other spouse must also itemize. As such, in lieu of a $0 standard deduction, they must both itemize. Non-resident aliens. If the taxpayer is a non-resident alien or dual status alien filing Form 1040 NR who is not married to a U.S. citizen or U.S. resident, they must file using the itemized deduction. If there is a short tax year, if the taxpayer files a tax return for a period of less than 12 months due to a change in accounting methods, they must file an itemized deduction or use the itemized deduction. Itemized deductions are reported on Schedule A, Form 1040. Non-resident aliens can also claim a limited amount of itemized deductions on Schedule A, Form 1040 NR. Medical and dental expenses are one of the itemized deductions you can take on Schedule A. Medical and dental expenses, other than self-employed health insurance premiums, are deductible only if a taxpayer itemizes deductions. Qualifying medical expenses include the cost of diagnosis, cure, mitigation, treatment, or preventive disease, and the cost of medical, but not cosmetic treatments. The IRS defined qualifying costs as medically necessary equipment, supplies and diagnostic devices, dental and vision care, transportation to obtain medical care, qualified health insurance and long-term care insurance. Deductible medical expenses include fees paid to doctors, dentists, surgeons, chiropractors, psychiatrists, psychologists, and non-traditional medical practitioners. It is also important to realize that there is something called SALT, state and local income taxes. The SALT cap used to be $10,000 and $5,000 for married filing separately filers. However, with the Big Beautiful Bill, this amount has now increased to $40,000. In the SALT computation, that includes state and local taxes, real estate taxes, and that would all add up to the allowed amount. There's also a deduction for home mortgage interest. Home mortgage interest is paid on a loan secured by a taxpayer's home. The loan may be a mortgage, a second mortgage, a home equity loan, or a line of credit. A taxpayer is allowed to deduct the interest related to a primary residence and a second home. The maximum amount of qualified acquisition indebtedness secured by a qualified primary or secondary residence depends on what the filing cap is for the year. It is important to know that charitable contributions are allowed on Schedule A as well. The rules for charitable contributions have changed. The temporary deduction for charitable contributions for taxpayers who do not itemize has expired. The special 100% of AGI limit for cash contributions was also not extended. The previous 60% of AGI limit on cash contributions has been restored. A taxpayer can only deduct a charitable contribution in the year it was actually made. A donation made by check counts if the donor mails it in the current year, even if the charity cashes the check in the following year. The contribution limits for charitable contributions are 60% of AGI for cash contributions to a public charity, specifically 501c3 organizations, 50% that applies to most non-cash contributions to public charities. Examples of non-cash contributions include furniture, clothing, and housewares. And then there's the 30% limit that applies to donations of most appreciated capital gain property that would have resulted in a long-term capital gain if sold instead of donated. Well, I hope we've covered most of the standard deduction and itemized deductions, and continue to watch some more videos that talk about credits.